Good morning, everyone. Welcome to today's year-end tax presentation. We're going to be looking ahead to the 2025 tax filing season, as well as kind of what to expect in 2026 as well. So, just some quick introductions here. My name is Tony Lucavoli. As Sam said, I'm our Director of Tax Consulting, and I'll be acting as the moderator today. And with me, I've got Mandy Shardul. Mandy is a principal in our private client advisory group, and also Paul Meany, who's a leader in our tax credits and incentives team. So, getting started here, not surprisingly, we will be focusing heavily on the newest piece of tax legislation, and that is the One Big Beautiful Bill, or what we will refer to today as OB3. And kind of how we have the presentation broken out is really two main sections here. So Paul's going to cover the business related provisions as well as business considerations for next year. And then we're going to turn it over to Mandy, who's going to be covering both the individual considerations as well as the individual tax provisions of the OB3. So we're going to be covering the kind of the full spectrum here, including any of the OB3 impacts, which means we've got a lot to cover and only an hour to do it. So we will be covering a lot of topics, but not necessarily digging too deep into any one specific area here. So this is meant to be an overall or just an overview of what to think about in the coming year. So before we get into any provisions, let's just start off with a simple background on OB3 and kind of how we got to this new tax law. And to do that, we need to go back to 2017, which is the year that the Republicans had passed the Tax Cuts and Jobs Act, the TCJA. And for those of you that remember, this was probably some of the most sweeping tax law changes that we had in several decades at that point. And it included some pretty big items. So it included things like the lowering of the corporate tax rate, so taking it down from 35% to 21%. It included all of the individual tax cuts, so not just to rates and brackets, but also things like standard deductions and all those other items in there. It completely overhauled our international tax system in the US as well. So a lot of stuff was included in that 2017 tax law change. Now, to kind of set the stage for 2025, these changes that happened in 2017 were not bipartisan tax law changes. They were, again, I mentioned Republican tax, it was a Republican tax bill. So in order to get this bill passed, the Republicans had to use a process called reconciliation, which basically gets around the 60 vote requirement in the Senate. And with that comes certain budgetary rules that you have to follow. So basically, in order to get this bill passed in 17, a lot of the individual tax changes, the non-corporate tax changes, were actually temporary provisions that were set to expire at the end of 2025. So at the end of this year, they were all going to go away. So we were looking at about $4 trillion worth of tax increases that were going to hit individuals unless Congress did something enacted. And that really set the stage for the election last November. The Trump campaign had focused heavily on extending these tax cuts. And, once the new administration took office, Congress really prioritized these tax cuts as well. And you can see on the timeline here as kind of it went along. We won't go through that, but it really only took about 6 months from the new administration taking office to the passage of the new tax bill, the OB3. So, that's about half the time it took back in 2017 when they passed that tax bill. So, this was considered very quick for Congress to be able to act there. So that's really the background. Just kind of summarizing what's included in the OB3. There's really kind of three buckets here. Number one, we've got the Tax Cuts and Jobs Act extensions for individuals. And that is, the $4 trillion that I just mentioned or referenced in there. And so those were extended, and not just extended, in most cases, these provisions were made permanent. We also have just campaign promises. So these were their promises during the Trump campaign that were brought up. So, you guys may have heard, no taxes on tips, no taxes on overtime, no taxes on Social Security, in which we didn't actually get, but we got a version of that Mandy will be covering in her portion of the presentation. And then just also, on their campaign promises regarding U.S. manufacturing, which has obviously been a focus for this administration. And Paul will talk about a couple provisions specifically targeting U.S. manufacturers. And just the last bucket on there is kind of the other items. So basically, what doesn't fit into the first two categories. And this includes some of the more controversial items in the bill. So items like the repealing or the phasing down of all the green energy tax credits, the extending or expanding the SALT cap. Those are really included in those buckets. And we'll cover some of these items as well. So we went through the background, we summarized the bill, and now I'm going to turn it over to Paul to get into some of the specific provisions and planning ideas for next year.
So thanks, Tony. So one of the first big pieces of news, with the tax bill is the qualified business income deduction, which is now permanent. So let's just try and kind of unpack this in plain English. So the QBI deduction, or sometimes you may have heard it referred to as 199A deduction, essentially is a provision that allows owners of pass-through businesses, such as an S corporation or a partnership or sole proprietorship, to deduct up to 20% of their business profits on their personal tax returns. So it was kind of a marquee feature, right, of the TCJA to give non-corporate businesses a tax break, but it was set to expire at the end of 2025. And so if you remember, the corporate tax rate went from 35% to 21%, but that was permanent. Well, this now, right, gives some sort of permanency to those flow-through entities. So the OB3 really steps in to remove that sunset so that the 20% write-off doesn't disappear. And so what this means in practice essentially is that, right, if you're a business owner or an investor in a pass-through entity, you can continue to, right, taking a substantial deduction over your share of the business income each year. So for high-level executives and owners, right, this keeps the effective tax rate on pass-through income lower than it would have been without the deduction itself.
Yep. So just one comment here. You can look to the right and see the tax rate comparisons between S corps and partnerships with the QBI versus C corporations. I mentioned earlier the corporate tax cut back in 2017 down to 21%. Now, again, if this QBI deduction was not extended, which we know it was, and also made permanent, as Paul said, you would have had a major tax gap between corporations and flow through entities. So the flow through entities, your S corps and your partnerships would have been paying around a 40% tax rate, while corporations would have been paying around a 20% tax rate. So a significant gap there that would have changed a lot of people's structures. Now it's not something we have to worry about with the permanence of the QBI deduction.
So speaking about tax advantages for businesses, another major one involves how you handle investments in equipment and other assets. So bonus depreciation is back to 100% expensing. So it's allowing you to immediately deduct the full cost of eligible assets like your machinery, your equipment, your computers, or potential vehicles themselves. So it was phasing down after 2023. So if you remember in 2023, it was at 80%. 24 it was 60%, and then it was set to be 40% for 2025. But OB3 reverses that and makes full expensing permanent starting in 2025. Now, there is one odd transition. Assets placed in service on January 1st through the 19th will only qualify up to that 40% bonus under that old law. And that really is just a correlation with, right, when the president came in, right, and when they came into power itself. So there is a little bit of interplay between those two. But January 20th forward, we're back to full 100% expensing, write-offs indefinitely. And so the impact is pretty straightforward, right? So you've got major purchases that now can be fully deducted up front, which ultimately will result in, right, boosting your cash flow or lowering your after-tax, cost of investments. One thing we also want to note is alongside bonus depreciation, there are also other sections like Section 179 expensing, which also gets expanded. So it raises that limit which also allows you to take a deduction on certain tangible assets or tangible property. It goes up to $2.5 million with a phase out beginning around $4 million. So this is also an additional thing that gives small and mid-sized businesses much more room to immediately expense equipment. Section 179 is an elective and limited by your taxable income, but it is ideal right when we're starting to think about that targeted planning in the forecast. So, again, 179, you choose the assets, it's capped at the 2.5 million, and then it's limited by your taxable income. And then you've got bonus depreciation, right, which is an automatic 100% starting January 20th, but there's no dollar limits, and it can also create or increase a loss.
Yeah, so just comparing 179 to bonus depreciation here, in most circumstances, most taxpayers are going to utilize bonus depreciation. There's a couple examples where 179, there's certain assets that are eligible for 179 that aren't eligible for bonus depreciation. So, think about things like roofs and HVACs, where you'd be able to immediately write them off under 179. You can't do that with bonus depreciation. And then there's opportunities like, just looking at that weird kind of carve out that Paul mentioned between 1.1 and 119, where you can only take 40% bonus depreciation. Well, that may be in a case where, okay, let's take 179 because we can deduct 100%, assuming we meet all the requirements for 179 for those assets, and then we can take bonus depreciation on the rest. And just another thing, Paul had pointed out the permanence of bonus depreciation. And I think this is one of the most significant items in the bill, not just the 100% bonus depreciation, but the fact that it is now permanent. Bonus depreciation was first introduced back in the early 2000s, so I think maybe 2001 or 2002, and it was a 30% amount at the time. It was a temporary provision. And since then, it's been kind of in and out of the law. It's been at all different rates, right? 30%, 50%, 60, 80, 100. It was going to be 40%, or it is for a portion of this year too. But this is really the first time that we have a permanent bonus provision in the tax law. And not just that, it's permanent at 100%. So that's a pretty significant factor for most businesses.
So bonus depreciation and Section 179 cover most personal property, again, your equipment, your machinery. But let's talk about buildings for a second. So traditionally, right, you couldn't expense real estate, but under this new tax bill, you can. So OB3 introduces kind of a new concept or unprecedented for certain buildings that are used in production. So it basically introduced a brand new incentive that no tax law is kind of allowed for in the US, which is the immediate expensing of certain commercial buildings. So this is called qualified production property or QPP deduction. And it was created under Section 168 of the new code. And in simple terms, right, if you build or invest in facilities, right, that are used for domestic manufacturing or other specified production activities, you can now deduct 100% of those construction or improvement costs right away. So, right, similar to bonus depreciation, but here it's for structures. So under the new provision, a building like a factory or a warehouse that had to be depreciated over 39 years, now you can potentially take it, all in 1 year. And so this is a significant tax break, really aimed at encouraging that domestic production and capital projects, which you'll see as a reoccurring theme, as Tony mentioned earlier, where there's a lot of tax incentives that are geared towards, right, let's produce or invest in the U.S. Now, one of the things that I think is important is the qualification and conditions itself. So QPP, again, right, means non-residential real property. So again, think of your commercial businesses and that it's used as an integral part of the qualified production activity. So you might ask, all right, what is qualified production activity? And essentially think of it as, right, the manufacturing or the production or the refining of tangible products. So your factories, your manufacturing plants, your processing facilities, places where you're actually making stuff. That's where the laws, explicitly wants you to boost those domestic investments themselves. That being said, there are some exclusions, right? So not every part of that building may be eligible. So portions of that property used for things like unrelated to the core production may be excluded. And so that might be certain office space, sales or showrooms or cafeterias. And another interesting one is R&D, which we'll talk about a benefit later on, right, where you can actually get some of the benefits for those internal or for those research and experimentation investments. So the 100% write-off is aimed at the production area specifically. So, this is where, as you're thinking about potential projects, you want to potentially allocate costs between qualifying and non-qualifying portions when you're thinking about that benefit.
And the key here again is that qualified production activity. Your company, your business has to be engaged in that. And that's one where, the statute offers pretty limited guidance on what that is, right? Manufacturing, production, or refining of a qualified product where substantial transformation takes place. So, right now, what we've seen is basically, we've got at one end, we've got clients that are clearly going to qualify, businesses that are clearly going to qualify. They're producing a product for manufacturing a product for an end user. And then at the other end, we've got, businesses that are clearly not going to qualify for this deduction. And, think about a wholesaler or someone who's just simply, storing products and then kind of moving them along. And then we've got all the businesses that are in the middle. And, that's the one where we're going to need some guidance from the IRS, from Treasury on a more defined definition of both QPA as well as a definition for substantial transformation of the property.
So in practice, right, if your company is a manufacturer considering a building of a new plant, or you're thinking about expanding maybe an existing one, this provision can drastically improve, right, that project's tax profile. Now, one thing to notice, the property's original use must begin with you, right? So you can't just buy an old factory, built, 5 years ago and then just claim this, right? It has to be new construction or substantial improvement that hasn't been used in the QPA before, or that qualified production activity. There's also some deadlines around this one. So while there are a lot of things that became permanent, this one does kind of have a time frame within which you're working. So the construction must start after that January 19th, 2025, right? Similar to what we just talked about for bonus. So anything January 20th and beyond. But before it must be started before January 1st, 2029. I'm sorry, it must be placed in service before January 1st, 2031. So another thing is there's no related or leasing. If you are a non-related party or you're leasing it, you are not eligible. So again, right, the goal is genuine new production of investments and not reclassification of existing assets.
Yeah, that last bullet point on there, that lease property restriction is something that the IRS is going to have to clarify. So, typically, entities, businesses are structured in a way that you hold the real estate over in a separate legal entity for multiple reasons. And so, if you look at just the straight reading of the tax statute, leased property is not eligible for QPP. And so we'd like to see the IRS come out with some type of exception that clarifies this is not intended to disqualify your related party leases, only the third party leases there. So, I had mentioned kind of in the earlier slide, campaign promises that were really focused on incentivizing U.S. manufacturing. This is obviously one of those, and Paul will get into R&D in a second too. But just for planning for next year, again, one idea that correlates with QPP, with bonus depreciation, is cost segregation studies. And a cost seg is basically a way to accelerate depreciation for buildings that would typically have like a 27 and a half or a 39-year depreciable life. And anytime we've got bonus depreciation to kind of layer on, cost segregation studies become even better than before. So if you just look at this very basic example here, and let's say we've got, $5 million of a new facility. We're building a new facility. And in this case, we'll say it's a production facility. It's qualified production property. So normally we depreciate that building over what their 39-year depreciable life or 40-year life. So you can see here in scenario one, if you don't do a cost segregation study, you're basically going to get $125,000 depreciation a year for the next 39 years. Now, again, if you look at scenario two here, same facts. The only difference is you do have a cost segregation study performed on the building. And in this case, it determines that 30% of the building cost is really eligible for a lower life, which also means it's eligible for bonus depreciation. So you can see that first year depreciation goes from 125,000 all the way up to 1.5 million. So a substantial jump just there alone. Now, in scenario three, imagine layering on the new qualified production property into this too, because all these things can be utilized together. And so, with qualified production property, let's say now we determine that 80% of this facility is eligible for QPP. So we deduct that 80% immediately in year one. The remaining 20%, we do a normal cost segregation study on. And now you can see there that first year depreciation jumps up to over $4.3 million. So, just something to consider, especially as you're thinking about investing in expanding a new facility, building a new facility, think about the first year kind of cash flow tax savings that comes along by just engaging in some of these tax opportunities here. Again, you're going from $125,000 of first year depreciation to over $4 million in depreciation in that initial year. So a really powerful tool here to consider is that cost segregation study.
One last thing I'll just mention as we went from QPP into cost seg is OB3 basically kind of put a big sign saying invest here, right? Or on the American industrial sector. And so, I think if you don't need to necessarily memorize everything we're saying, but it is about, right, just providing you the information to recognize when it might be beneficial. And so, right, we've talked about the deductions for income, right, through QBI. We've talked about deductions for investments through bonus depreciation and QPP, and cost segregations. But now we want to kind of shift a little bit to interest expense deductions. And so, if your company carries significant debt, you might be familiar with the business interest limitation under Section 163J. So essentially, the rule brought by the TCJA limits the amount of interest expense a business can deduct in a given year to a percentage of its income. And so originally, from 2018 to 21, there was a limit of 30% of EBITDA, or earnings before interest, taxes, depreciation, and amortization. However, starting in 2022, that was tightened to 30% of EBIT, so only earnings before interest and taxes. And so you lost the depreciation and amortization, which creates a harsher limit because not being able to add that back, the depreciation means a smaller income base essentially to measure your 30%. So many capital intensive or highly leveraged businesses saw their deductible interest drop due to that change. Now, OB3 permanently restores that to the EBITDA-based calculation for the 30% interest limit. So kind of in simpler terms, right, when figuring out how much interest you can deduct, you're allowed to add depreciation and amortization back to your earnings again. So this tends to increase, right, the cap significantly, meaning that your interest expense becomes deductible. And so this changes effective from 2025 onward, and it basically puts back in line with most other countries do for what the rule was initially, rather than what it was originally, rather than the stricter version that just took effect a couple years ago. And so again, right, if your company has a lot of interest expenses, common with, say, the real estate industry or the privately owned firms or any business that really finances a lot of operations with debt, you'll now have an easier time deducting all of that interest. So fewer companies will hit that 30% EBITDA than they would when it was 30% of EBIT. And so again, right, it means lower taxable income and taxes for heavily leveraged companies. It also will eliminate the need for, maybe more complex planning or workarounds. And so purely for interest deductibility reasons. So in short, right, financing costs remain more fully tax deductible, which generally is good news for businesses and investments and expansion itself. One of the other things I'll mention real quick is on the top of deductions and reporting is some compliance relief regarding 1099 reporting thresholds. So many of you might have been following kind of recent changes or even headaches around, right, the IRS reporting for payments. Well, the law has increased the reporting thresholds if you have third-party contractors to $2,000. So it's adjusted for inflation. So in practical terms, right, this means that if your business pays an independent contractor or a service provider, right, you won't need to issue a 1099 form unless you paid at least $2,000 in that year. This is up from the threshold of $600. So this essentially, right, is an administrative burden that you previously may have had, and it's just now reducing some of that paperwork for the smaller transactions.
Yeah, so just two things to kind of reiterate here. So on the interest expense limitation, again, it's not going away. It's still here. But as Paul said, with the changes of the rules or reverting back to the original rules, it's going to be a lot easier for kind of highly levered companies to be able to deduct their interest expense, especially if they are investing heavily in things like fixed assets and taking bonus depreciation. And then just on the 1099 relief, again, on the slide there, just pointing out this is in effect in 2026, not 2025. So when you're coming to the 1099 filings that are due over the next couple months, you still do have that $600 threshold that you have to comply with. So that is not effective until 2026.
So we've talked a lot about some of the significant benefits, the permanency of a lot of provisions. One aspect of OB3 that might have shifted the other way is OB3 significantly rolls back or even trims some of the clean energy tax credits that were expanded just a few years ago under the Inflation Reduction Act. So while many of the focus today has been on business taxation, many companies have been involved in projects or purchases that rely on these energy credits, whether that's installing solar panels on facilities, buying electric vehicles for a fleet, developing renewable energy projects. So we do think it's important to at least illustrate that the landscape has changed here. So in essence, OB3 accelerates the phase out or termination of multiple energy incentives. So for example, the residential energy efficiency credit and the residential clean energy credit, which homeowners and builders have used for things like installation or efficient windows, solar panel, geothermal, that were supposed to last in the 2030s. OB3 ends these much sooner. So home improvement credits end after 2025. Residential clean energy, like solar, is terminated for expenditures after 2025. So for those business leaders, right, I think the main thing to digest here is, right, the generous clean energy tax breaks from recent legislation have been pared back. So if your company was planning to invest in solar installations, right, energy efficient upgrades, or electrical vehicles expecting federal tax credits for the next decade, we just need to kind of reevaluate those timelines in those ROI calculations. So many credits will be gone or reduced after 25 and 26. So there still is, a little bit of a last call happening, but it doesn't mean you shouldn't do these projects. But if the credits were a key part of that planning or the financing, you just may want to accelerate some of those actions now that we're under the wire a little bit. So research and experimentation. So arguably one of the more transformative provisions under OB3, especially for innovative companies. So whether you are in technology, if you have advanced manufacturing, life sciences, or any really research and development intensive sector, there's this restoration of the immediate expensing for domestic research and experimentation costs. So beginning with tax years after December 31st, 2024, so essentially, right, the 2025 tax year on January 1st, right, businesses can once again deduct 100% of US based R&D expenses in the year in which they incur. So this is a major shift away from the TCJA requirement that in 2022 forced companies to capitalize and amortize the research and experimentation costs over 5 years if they're US or 15 years for foreign research. So to kind of give you a visual as to, what was that impact, right? If a business invested $10 million in the US in 2023, it could deduct only 2 million per year under the old rules with a kind of a 5-year amortization window. But under OB3, that same $10 million invested in 2025 could become fully deductible immediately, right? So that drastically is improving your cash flow, and it's reaffirming, right, the federal government's commitment to supporting innovations there. Now, it's critical to understand, right, that this immediate expensing is only applicable for domestic R&D. So if you have foreign R&D, that remains a compliance requirement and is still subject to a 15-year amortization period, right? Which will now create a clear distinction in the tax treatment of U.S. versus non-U.S. research activities. And this again goes back to that broader play of, right, invest in America or domestic manufacturing. And so for many companies, right, this renewed incentive may directly impact, right, the influence or the decisions about where to locate a lab or engineering teams or development centers. So um, one thing I will say is, although taxpayers can you can still elect to capitalize R&D if they prefer smoothing income over time. Um, the vast majority will benefit from the immediate expensing due to the significant cash flow advantages. But we do want to note that while the default is now to expense, you still will have the opportunity to capitalize and amortize if it's best for your tax posture. So companies that have been required to capitalize R&E since 2022 will now need to kind of revisit their accounting methods. And many will potentially want to or need to file a method change again to return to expensing beginning in 2025. Now, there is one sort of caveat. If you are a small business under OB3, it goes actually even further, offering some retroactive relief. So companies with an average gross receipt of 31 million or less over the past 3 years can now retroactively deduct those R&E expenditures that were capitalized over the 2022 through 2024 period. So this may be done at this point via an amended return, since most of the 2025 tax years, or I'm sorry, either an amended return or you can kind of catch up in 2025 doing a 41A adjustment, which will allow for any remaining capitalized R&E to be deducted all at once. So this type of retroactive benefit is unusual in a tax legislation package, especially for small qualified businesses. So it's something we just don't want you to overlook, since there might be some flexibility on how to address that. Across all industries, companies really should just kind of take a moment to reassess, right, their R&D budgets, right? Since this is a drastic change, right? It's just important to kind of evaluate the impact on the effective tax rates, review all of your R&D activity, kind of dating back to 2022. And so, with that goes accurate documentation of what was capitalized and amortized during that period. And it's essential, right, if we need to deal with method changes or amended returns or proper substantiation going forward. One other thing regarding research and experimentation and research and development is under OB3, it did not change the federal R&D tax credit. So the restoration of immediate expensing makes that credit more powerful than ever, right? So it's expensing and the R&D credit can still be used together. So now is an ideal time, right, for companies to reevaluate their credit strategy. So ensuring, right, that the capital of all that we're trying to capture all of the qualifying activities, reinforcing, right, the documentation to substantiate these claims. So with this expensing back in place, tax, financing, engineering teams really should kind of just work cohesively together to really identify the cost and to maximize both those benefits or incentives. So taken together, right, these changes are an important opportunity. So by aligning your R&D or investments, documentation, tax strategy, right, you can now kind of significantly reduce your tax liabilities. Again, it will enhance cash flow. It will also create an incentive to innovate itself. So again, right, that restoration of immediate expensing paired with kind of a robust R&D credit strategy can create one of the more favorable environments, along with, right, the bonus and the QPP itself. So, right, this is for American innovation. It's one of the greatest incentives we've seen from a tax package, potentially ever, but at least, right, in the last couple decades itself. Now, one last thing on R&D. Across the country, there are several states that increasingly use R&D credits as a way to attract and retain innovation companies, highly waged or technical jobs, long-term investments. So while each state structures their credit a little bit differently, the core message for businesses is kind of really clear, right? State level incentives can be meaningful and really amplify the value of your federal R&D credit strategy. So if you plan for them early enough and understand the rules, this could be something to really take advantage of. And so many states will follow a federal definition of qualified research expenditures, which typically will include your wages, whether it's technical staffs, it could include certain supplies, contract research, cloud hosting environment. So the alignment simplifies compliance and allows companies to really leverage, right, the existing federal documentation, right? Because normally you'd calculate the federal credit and then you just kind of allocate or apportion, right, the state activities to see how much you'd be generating a state credit. So long story short, right, the bottom line is if your company really performs research and development in any state that offers an R&D credit, you should just kind of begin preparing now. So, right, align your federal and state documentation, kind of understand each state's deadline and methodologies, and we can kind of help forecast the potential benefits. So, again, this is one where if we can get out of front, there can really be a lot of advantages in multiple states, and you can be really well positioned to capture kind of the full value of these incentives in 2025 and going forward.
And just while we're kind of on the topic of states here, I want to just add in one more thing before we transition over to individual tax provisions. But you know, we have been talking about the planning ideas and OB3 benefits on the federal income tax side, and Paul had mentioned looking at R&D credits also from federal as well as state. But it's important to consider the state income tax impact of some of these new tax provisions that we covered. So, I do just want to point out that many states are choosing to decouple from a lot of these provisions that we just covered, right? They're not following the federal rules. So things like bonus depreciation, Paul just covered R&D or R&E capitalization or the removing of that requirement. Not every state is following that. In fact, many are not following those provisions. So what's going to happen is if you are doing business in a state that chooses to decouple, you may end up in a scenario where you have a large overall loss for your federal income tax purpose. And when you get to calculating your state liability, your state taxable income, you could have a large amount of income being shown there for that same year. So same facts, just two different methods for calculating your taxable income. So just one thing to point out, again, when you really need to consider not just the federal benefits, but the state tax impact on your business taxes. And you can't, again, just assume that just because you show no federal tax liability, that in the end, you're not going to end up owing something to the states. So just keep that in mind as you're talking about state tax payments for 2025, estimated payments for 2026 as well going forward, that you really need to factor in what each state that you're doing business is, what rules they are going to follow for some of these new tax provisions. And just pointing out on this slide here, this is just a kind of an estimate of the cost of the provisions here. I talked about depreciation being one of the more significant of all the provisions, and you can see here depreciation in the first row there, as well as the new qualified production property. You add those together and you're at about $500 billion worth of cost of the bill. So those are some of the larger ones. And if you look down to the bottom here, the only other one I want to point out is the only revenue raiser we have on this list here, and that's what Paul covered with his termination or early expiration of many of the green energy tax credits there. And you can see that basically offsets the cost of the new depreciation rules or the expanding of bonus depreciation. So with that, I'm going to turn it over to Mandy to get into the individual tax provisions and planning ideas for next year.
Thanks, Tony. Paul, that was great. Thank you. So, hello, everyone. We are now going to talk about the individual provisions related to the OB3. And one of the things that was a big relief was that the Tax Cuts and Jobs Act tax brackets, those were permanently extended by the bill. And so that maintains the top marginal rate at 37% instead of reverting back to the 39.6%, which was the pre-TCJA. And then it also boosts the income thresholds for lower tax brackets. So This is indexed for inflation as well. And so if you go to the next slide, we're going to show, can you do that? Okay, great. So in addition to that, the standard deduction, as everybody remembers, back when TCJA was passed, one of the goals for that bill was simplifying the income tax filing. And to do that, they increased the standard deduction. So a lot more taxpayers were able to file their taxes without collecting all their receipts from Goodwill, all of the different things related to their property taxes, their car registrations. If you all remember having to do all of that with this much bigger umbrella, the standard deduction allowed for less people to, or for more people to be able to take it, and less people to have to itemize. So this relief was that when the OB3 was passed, it continued to extend the increased standard deduction from the TCJA and also added inflation adjustments for that as well. So you'll see that this year, 31,500 is the standard deduction. And so just to put it in plain English, because sometimes I even have to remind myself, when you look at the itemizing, why would you itemize? You would itemize if there's only four categories. So the categories would be charitable deductions, your interest expenses, your state and local property taxes. So that includes the income tax you pay at the state level as well as your property taxes. And then the last one is your medical above the 7.5%. So if you added up all those things and you were married filing jointly over 31,500, that's when you would itemize. Otherwise, you take the standard deduction. And that's important to emphasize right now because we're going to talk more about that next.
Yeah, and just on that slide, Mandy, you talked about kind of the changes that happened in 2017, and you can see even before 2017, the majority of people in the United States, 70%, were taking the standard deduction already. So if you increase it, you make it more beneficial. Obviously, there's going to be more people that are going to fall into the standard deduction range there, and you can see that jumped up to 88%. That's just with the TCJA changes. And right now, that amount of people taking the standard deduction is past 92 or 93% at that point. So again, the vast majority of Americans are not itemizing; they are taking the standard deduction.
Great. So also with the OB3, one of the permanent changes, or it was a permanency that was enacted, was the child tax credit that was permanently put into the bill, and now that has been increased to $2,200 beginning in 2025. So what I think is going to happen is there will be a good portion of people who will probably be getting a bigger refund than they were expecting. So that is good news. On the AMT front, there were some changes there as well. One of the things I wanted to highlight was that last bullet point. It increases the phase out rate to 50% versus the 25% under the current law. So that steepens the clawback for upper income filers. All that to say that we were sort of all glad, I think, that some of these AMT headaches were gone and even having to think about it. But that now reintroduces itself as a consideration. It becomes one of the moving pieces that needs to be looked at as we do tax planning. All right, this is the state and gift tax exemption. I will say I was very, very glad that this guidance came out on July 4th versus on December 25th, because we all remember all of the threats, including back to 2012, when everybody thought the amount that you could either gift during your lifetime or pass away without being subject to state tax, that was supposed to drop back to $1 million back a long, long time ago. But obviously, that didn't happen. And now what we've got is a permanent $15 million per person threshold before a taxpayer is subject to the state tax. So that is for the single taxpayer. As a married couple, you have a $30 million exemption amount. And the only thing you have to remember is that There's this rule called portability that passed a few years ago, which allows spouses to share exemptions. So if you want to use the decedent's unused amount for the spouse on the second to die, then you do have to file a tax return for that. But this is a good time to remind everybody that as we come up to the end of the year, this is a great time to make your annual exclusion gifts. Those are the $19,000 per person that you can give away to anyone. If you're looking to you don't have to be in a taxable state to know about that rule. If you give away $20,000 or $19,001, then you have to file a gift tax return, or you're supposed to. So it's a good reminder for that. And the only other thing I wanted to stress here is there's a lot going on with income tax planning related to estates and trusts, and you do not need to be subject to the estate tax to understand that a lot of core estate planning documents are designed with a hard wire in them that creates certain trusts when people pass away. And those hard wires, I think, should be relooked at with these larger amounts, just because we don't get basis step up for things that are permanently put in these trusts at the first person to die. And there's a ton of tax planning that we just need to look at. So I don't want to go over on my time on this slide, but it is something I'm really interested in and something I think that we have a lot of opportunity to help with. So let's go to the next one, Tony. Okay, the SALT cap. This we all, I think, remember hearing a lot of debate on this. What ended up happening with the state local tax cap, that refers to the federal limit on how much taxpayers can deduct for state local taxes, including property, income, and sales taxes from their taxable income. So that has been temporarily increased. So this is one of these things that is not permanent. It ends in the tax year 2029, but that cap was raised from $10,000 to $40,000 starting in 2025. So as people were starting to cheer, then they looked at some of the fine print on the bill, and that's where you get to see this phase out, where if your income is $500,000 or more under the modified adjusted gross income, $250,000 if filing separately, your deduction starts to phase out, and it's fully phased out when you get to $600,000 AGI. So you then, let's say you have over $600,000 of your AGI and you paid $50,000 in property taxes, you are still going to only be able to deduct the $10,000. This SALT cap increase does, the thresholds do increase annually by 1%. Anything on there, Tony, you want to highlight, or?
Yeah, I do. Just going back to some of the business provisions here, the salt cap, as Mandy said, has, it's been increased, but it phases out when you're over a certain threshold. So for anyone in a pass-through entity who has been, an S corp in a partnership, who has been electing into their state's pass-through entity tax regime to basically get around the salt cap, the importance of that has not gone away. That is still beneficial. If you do the math, even if you fall into being able to take a higher SALT deduction, there's still many cases where it's still better to take the state or to elect at your pass-through entity level to be taxed at that entity level.
That's a great point. Okay, charitable is a big deal because you're taking notes. This is a really important element for 2025. So if you do end up itemizing your taxes, and again, I told you guys about the four categories, where if you're over that threshold of 31,500 married filing jointly, that's when you start to itemize. So if you are an itemizer, this year, when you give and donate to charity in 2025, you are going to get your full charitable deduction. Next year, starting in 2026, and this is permanent, if you take out your calculator and you get your modified adjusted gross income, and you multiply that by 0.5%, which is 0.005 on the calculator, that amount is it's a threshold or a floor that you have to get. Anything that you donate above that is deductible. And I'm going to give you an example. So let's say your modified adjusted gross income is $200,000, and you make a $5,000 contribution to your favorite charity. Well, the first $1,000 is going to not be deductible, but the following $4,000 are. So that's new. That is going to apply again to itemizers. That's why this year is a great year to start, if you haven't already, to think about your charitable strategy, think about your cash flow, think about highly appreciated marketable securities. As long as you get your donation done by the end of the year, you're going to get the full count on that. Now, if you're saying, well, maybe I want to give to charities over several years like I normally do, that's where you, if you don't have one already, can consider a donor advised fund. Some people call them DAFs. But that allows you, I look at it like a charitable gift card, like you pre-fund it and you get the full deduction, but then you can sprinkle out the gifts however you want to. And donor advised funds are pretty easy to set up. We'd be happy to talk to you about that if you're interested, but it's a way to get that deduction now, and then you get the full amount and you can do more with it later. Tony, in the interest of time, do you want to go to the next slide? Great, thank you. So qualified tips deduction. So I'm going to first give the bad news. It's completely phased out for individuals with a modified adjusted gross income of $400,000 or more, or $550,000 for joint filers. So it is also reduced 10% for every dollar an individual's modified adjusted gross income exceeds 150,000 or 300,000 for joint filers. So after I get that bad news over with, if you are under those threshold, that threshold, you can individuals can deduct up to $25,000 in qualified tips. So I really like this this part of it because I've got a daughter in college and it will hopefully help her. All right, here we go with the OB3 individual tax provisions on overtime compensation deduction. This is also new. This was also in the campaign. This also has a phase out for adjusted gross income exceeding 150,000 or 300,000 for joint filers. If you're under those thresholds, then you can deduct a maximum of 12,500 per year on the individual side or 25,000 joint filers. And this is only good for 2025 through 2028. So you have to pay attention and we'll help you, but pay attention to, which things expire, which things are permanent. That's really important. Anything else on that, Tony?
Yeah, just one quick comment. The IRS did come out with some reporting relief for both the employers and the employees over the past month. So on the employer side for 2025, since the IRS is not updating the W-2, you are not required, but I think they use the term highly encouraged to provide these amounts to your employees so that they can report it on the returns, but you are not required to. On the employee side, if your employer is not providing you with these amounts, there is a notice that the IRS put out there a week and a half ago that shows you how you can calculate these amounts on your own as well. So if your employer is not giving you these amounts, just look for that notice and you'll be able to figure out how to calculate that, at least for 2025. In 2026, it will be different, but for 2025, there is some transition relief.
Thank you. Okay, this is good. There's an enhanced deduction for seniors. So already, if you're over age 65 and you're blind, there's a $1,600 this year increase to your standard deduction. Well, now on top of that $1,600, starting this year, if you're over 65, you're going to have an additional $6,000 that you can use as a deduction if you're an individual and you're over age 65. If both people are over 65 and they filed married filing jointly, it ends up being 12,000. Bad news again. This phase out threshold begins at $75,000 for individual modified AGI for individuals and $150,000 for joint filers. Okay, let's go to the car loan interest deduction. This is the maximum deduction is up to $10,000 per year. You can look at that income-based phase out, it begins at 100,000 for individuals and it's fully phased out at 150 for individuals for married filing jointly, 200,000 fully phased out at 250. This is interesting because it has to be a new personal vehicle and final assembly must occur in the United States. And I believe that that is still probably going to be getting some guidance on what that really means. But if you're looking for a new car, this may be the time between 2025 and 2028. And then 529 plans. So they did actually do quite a bit to enhance the 529 plan. I think the goal is they're trying to make the 529 plan more flexible and including for adult learners. So, in addition to tuition and curriculum instruction materials, now if you have if you need tutoring for your kids or your grandkids, if there's private school, you see right under the first bullet point, the withdrawal limit now, it's doubled from 10,000 for private school to 20,000 starting in 2026. So now private school that is not college, it's just K through 12, you can take money out of the 529 plans for that. And so I think that's going to be really, really helpful for people. Of course, states don't always follow federal, so that's going to be something to highlight if you end up doing something K through 12. But there's just so many other things, including homeschooling resources and so on and so forth, that it's expanded under the OB3. Tony, do you want to take Trump accounts? Because I think you'll do it faster than me. And in the interest of time, I'm just going to let you, if you're okay with it, take over on
Sure.
whatever we want to highlight here.
So Trump accounts, they're basically a new type of kind of savings account for that was created with OB3. You can look at all the specific rules. I do want to highlight a few of them. There are contribution limits every year on how much you can contribute. You also have to be setting up the beneficiary has to be under the age of 18 as well. And so this is again another type of savings account for children that you can kind of layer on with like a 529 plan or something along those lines there. But there's restrictions that go along with this. I kind of summarize it this way. It basically acts kind of like an IRA. Eventually, you're going to get to converting it. It's going to basically act like an IRA when you get to a certain point. And so, the one thing I want to point out is a couple of, well, first of all, for employers can contribute up to $2,500 to a Trump account. So great if you're thinking about providing your employees with some type of benefits. This is one to consider. It will be tax-free to the employee, deductible for the employer. And the other thing I want to mention here, again, you can see all the different rules with distributions and stuff like that. Again, if you're familiar with IRAs, it's acting very much like one. But I do want to point out the news that came out this week. Part of one of the benefits with these is there's $1,000 seed funding essentially for, if we go back to the slide here, for any U.S. citizen born between 25 and 2028. So the federal government will fund $1,000 into these accounts. Now, the news that came out this week is that Michael Dell, the founder of Dell, donated about $6 billion to provide additional funding for the first 25 million Americans that live within a zip code where the median income's under $150,000. So they'll provide an additional, on top of the $1,000, an additional $250 into these Trump accounts. So, the question that we get the most is how do I set one up? And we don't have the answer to that yet. The online portal, there's a form you can fill out right now if you wanted to, but the online portal is not expected until I think mid 2026, they said, where you'll be able to jump in and sign up. So I can see we have about 1 minute left. So I'm going to skip down to here. Just want to point out resources. If anyone is interested in kind of, again, with these, we're just kind of going high level on all these provisions, but if anyone is interested in learning more on any of the specific items that we covered, specifically related to OB3, there's a series of articles and resources. If you click on that link or go to that link, that you can really kind of dig into some of these specific topics that we covered. And again, we are out of time. I know we do have quite a few questions. If you did submit a question, we are taking those down. We will review them and we will be in touch if we've got some contact information on there. So with that, I just want to thank everyone for joining us today. Thanks again to our speakers, Mandy and Paul, and enjoy the rest of the day. So thank you, everyone.